Alright, so this is the second part. Now we're covering the downtrend. So what I've covered is the climax up here, right? Buying climax and that change of behavior. And that change of behavior is basically first time the volume so hard, so big on a down bar. Before that it was small, and now you have big volume in the down bar. What's really going on? Like, instead of talking about price, volume, time, like what is going on in terms of people? All right, and what beyond technical analysis, what's going on in terms of the CM or the CO? And what's going on is he's selling. He's selling a shitload. He's selling on the way up and then selling on the way down because he was done selling on the way up and no more buyers wanted to buy on the way up, so he sold on the way down, getting the best prices at these two bars. Selling on the way up, then selling on the way down. After that, he cracked right here. Market cracked. And why did it crack? Because the buying, the orders here, they've been removed from the market. Why? Because other traders have picked up that there's selling. They're selling. So they know that. What are they going to do? They're going to take away their orders. So what does that mean? That means the market's going to easily go down. Why? Because there's no orders. How do you know that? Because the range has expanded. Like, if you take a look at this range, this is the biggest range in a lot of bars. That's the biggest range in a lot of bars. Why? Because the orders underneath at prices, the buy orders are removed. They're taken out. So when buy orders are taken out like that, and I mean like they've been removed, right? So what that means that the sellers will meet buyers at much lower prices. So if they're going to meet buyers at much lower prices, guess what? Prices are going to go to a much lower price. So the result of that is an expansion in range, meaning the spread from high to low is going to be big. It has to be big because there's no fucking orders. That's what happens. Alright, my mouse died, so give me a minute. Stupid ass. One second. Shit, AAA. Anyway, while I'm doing that, the behavior right after that, what was it? It was basically the market climaxing with a small rebound and setting up a rally which is supposed to short on the bulge, which is going to go halfway back. Why is it going to go halfway back? To discourage amateurs, because the amateurs are going to be trying to play that support and resistance game. So if it goes up too high, they're just going to short it. Why? They're going to try to get some reversion to the mean or whatever. And want to discourage that, so the rally or the pullback is going to go only about halfway back. It has to only go about halfway back, otherwise the shorts will have an opportunity to enter. You don't want that. If you're the CM, you definitely don't want that. Stupid cat. Alright, let me see if this works. Doesn't work. Oh, there it is. Alright, so, long story short, Sell the bulge. What bulge? Right there. How do you know to sell it? You know the level. There are other ways that you know that it's gonna go here. There's typically a couple of ways to do this. I'll be going over all that too. Renko is a great way. If you have Renko with volume, you'll know which levels have a lot of volume, and you typically bounce to those levels. Or if you just see a bar chart and see where the volume is, like here. So anyway, it's a point here. So that's how far. Damn mouse. I have a lot of problem with the mouse. Alright. Okay, so we're over here. And now this is February, I think 10th. March 10th? Oh, March 10th. So the decline goes down 14 points. What should you expect? You should expect the halfway back, which is what? Obviously 7 points, right? So that's where it goes. Volume on this rally is not measuring up to the standard. What standard is he talking about? What he's talking about is the rally volume versus the pullback volume. Clearly, obviously, the volume here on this advance is much more than this. So that's the volume on this rally is not measuring up to the standard of the February rise, which had a hell of a lot of volume, which marks this rebound as purely technical. I mean, again, it's nothing more than the same like move here. We have a lot of volume down on this wave. He's going to take a look at this pullback here and compare this down wave to the prior down wave. The concept is the same. This up wave he's comparing to this up wave. And you go, oh yeah, this has much less volume, therefore the volume is not comparing to the February rise. February rise, a lot of volume. March rise, not a lot of volume. Here, December down wave, lot of volume. Late December down wave, not a lot of volume. So the volume is not measuring. So how would you measure the volume? Yeah, you could take a look at it on a volume. This type of chart, basic histogram volume, but it's very clear on wave volume. If you use wave volume, it will be very clear. One thing though with wave volume is if there are a lot of bars, it's going to sum them up. If it sums it up, it's going to look like a lot of volume, even though, because there's a lot of bars. Those lot of bars, even if they have little volume, if you add them up, it's a lot of volume. So it's a lot of fucking volume. Shit. I gotta stop the video and fix my mouse. Stupid ass. Anyway, moving on. Hopefully. Alright, so volume on this rally is not measuring up, marks the rebound as purely technical. Why? It's the rebound on lower volume. But like I said, if you have a lot of volume, not a lot of volume, but you have a lot of bars, it's going to sum them up. And it's going to look like effort reward. So you just have to be cognizant. And in my opinion, I keep coming to this conclusion that both are required, bar and wave volume. I don't believe that one replaces the other. I know other folks have totally replaced ball volume with wave volume. I don't think that's a good thing to do. And the reason why that should not be done is because you won't be able to detect the minor climaxes on the swings. Bang, case closed, argument made. Alright, now, where else? As a result of filling up all the bias on the previous distributive movement, thus confirming the probable accuracy of other deductions. Okay. All he's saying is that they got all filled up over here on the climax and they're exhausted. So around the top, we take our additional short position. Where does he take the additional short position? Right here. Okay, good. Selling at prices as close as we can to the danger points of the individual stock chart, so our risk is limited. Further symptoms of progressive weakening on the market's position appear in the dip to March 13th. What dip? That dip. Alright. Why? The volume again remains comparatively high instead of shrinking appreciably as it did during corrective actions. So all he's saying is this dip right here. Try to isolate it. Alright, so it's around 3 million mark, 2.5, 2 to 2.5, and 3 million on this dip, right? So let's take a look at the different rallies. I mean pullbacks. This is too much of a pullback, but whatever. It's around it never reaches 3, so this, you could say this area is less. This is even less. It never cracks 2 on the pullback. For sure this is less. Here it's questionable. Here, and the reason why it's questionable, this is distribution. This was early preliminary distribution. So other pullbacks, you can clearly see that when this down wave occurs, it has more volume. It breaches 3 million. So prior to the early distributive down waves in here, or the bars in here, the rest of them is correct. This has more volume. The volume again remains comparatively high instead of shrinking appreciably as it did during the corrective reactions of December. Whatever, this is December. Corrective reactions of December. I'm not even sure if this is the only one here. So if you're going to compare it all the way back here, not really sure why he did that, to go all the way back here, corrective reactions of December. Well, whatever. Okay, January. Oh, here we go. It's not just December. It's December, January, and part of February. Yeah. And the 4 part of February. And on the 13th, we find the average down to 158, which it makes a lower low. So what's he saying? He's saying that this block is preliminary distribution. This is your climax. This is your change of behavior. This is heavy selling with this big bar here breaking the trend or backbreaker. This pullback being a area of shorting, and then after that this rally down having increased volume and making a lower low relative to the reaction volumes, the pullback, the reaction volume here, December, January, February, 4 part of February, which just means right here. Okay, that's what he's saying. Anyway, we find the average down to 158, which is a point lower than the previous supporting point of March 4th. This substantiates the correctness of our general bearish position and suggests, the fuck does it suggest? I have no clue. Alright, okay, so this substantiates the correctness of our general bearish. Obviously, if it's making a lower low on increasing volume, it's bearish. That's all he's saying. So, I mean, this is very obvious. Like, if you have a market that's bearish, it's going to make down waves that are bigger in time, in price, and volume. So, whatever. In judging volume behavior, allowance must be made for the fact that declining markets normally are accompanied by lower volume than advancing markets, except perhaps at times when active liquidation is taking place. The reason for this is that bull movements attract much greater public following than bear movements. Whatever. All to deal with that, all you do is you compare the down waves with the other down waves. That's it. Further, selling the subsequent rallies if not sold in full line. In the following several sessions, their irregular recovery to 166 with no material nor consistent expansion in volume except for a sudden increase on the 19th. Very important. Very, very important. So, what's he talking about? You got this. One. So, yeah. Ding, 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 doink. Right there. Alright, so the sudden 17, 18, 19, right here. You see that volume right there? That's a sudden increase in volume. What is that sudden increase in volume? That is a climax. What kind of climax? Buying climax. What kind of buying climax? The type that terminates a swing, not a trend, a swing. The buying climax that terminated the trend is here. This shit right here. That on 5 million, which is biggest volume on the trend, the entire trend. Here is typically the biggest volume on the swing. Get it? Trend ending climax, swing ending climax. Terminates. But the biggest volume on the swing. In the following several sessions, their irregular recovery 166 with no material nor consistent expansion of volume except for a sudden increase on the 19th, which has all the earmarks of a sudden of a what? For a sudden increase on the 19th, confirmed by hesitation. Okay, confirmed by hesitation or lack of further upside progress on the 2 days. So now he's given a very subtle hint, and this is how you need to decode Wyckoff, because this guy, he doesn't teach. He just did his trend study with all those concepts. So I'm not sure where he taught the concepts, but it's not in this course. He's teaching by example here. And to be frank, I think maybe he had another course, or maybe in his magazine of Wall Street or wherever, where he goes over actually teaching what those concepts are. Over here, he doesn't teach them, he applies them. That's why his studies are not understood by many people. Anyway, so confirmed by hesitation. So how is he confirming the minor climax? The minor climax is confirmed by hesitation. Hesitation is lack of further upside progress. Lack of further upside progress, which means from close to close, it doesn't make any progress in the next 2 days. In fact, if you take a 2-day indication, it's red, right? So we now also know that the average is faltering about a point below the top of the rally of the 10th at the level where our previous deductions led us to anticipate just such a probability. Oh, whatever. I'll tell you something. Here, watch this. So this you're not going to find anywhere else, by the way. The morons on YouTube don't know shit. So over here, you have rally, and then you have a pullback, right? What is this? Well, up to the end is the biggest volume on the pullback, right there. the biggest volume on the pullback. So this is pullback. That's the biggest volume. Alright, now here, that's the biggest volume on the pullback, except for this buying climax, which was the biggest volume on the rally, followed by the biggest volume on the pullback. And this bar kind of screws things up, but if you know, up to that point, it's the biggest volume on the pullback. That's the reversal. Alright, and then you just have a dip and then relax. Okay, fine. Next, biggest volume on top of the swing. Next, biggest volume on top of the swing. Hold. Next, biggest volume on top of the swing. Not the biggest. Actually, it is the biggest. Except for the change of behavior. Let me see. Except for the change of the behavior, biggest down volume, which set up the bounce. And here, biggest volume on top of the swing. You see? And then ding ding, reversal. So the point that I'm trying to make is the climaxes are important and typically identified by high volume, which many times is the biggest volume on the swing or in the trend, or second biggest volume, or biggest volume since some shit. So it's going to be high volume. This is why this concept of price is king, or concept of we just trade price and momentum without volume is ludicrous. Volume will indicate when supply comes in on an up wave and when demand comes in on a down wave. That's pretty damn important. Anyway. We now also note that the average is faltering about a point below the top of the rally of the 10th added level, which our previous deductions led us to anticipate just such a probability. We watch carefully for further development, realizing that the average has reached a critical position. Should new demand fail to come in here, we may anticipate a decline in proportion with the extent of the primary distribution. So we watch carefully for further development, realizing that the average has reached a critical position. Man, all it did was tag or test here. So that's your critical position. Should new demand fail to come in here, we may anticipate a decline with the extent of primary distribution, which means just go to the left. That's your head and shoulder. Go to the left shoulder, all the way to the right shoulder, do the count, and bang, that's your target. Stops on our short positions may now be bought within 1 to 2 points above the highs of March 10th or whatever right here. There's more lateral movement. There's more lateral movement over the next 3 sessions, featured by a weak rally on the 24th and 25th, making a total of 6 sessions, during which the average has hesitated just under the lows of February 20 to 28 trading range. The market's inability to overcome the high of March 10th and its failure to even equal that level means he's just saying, oh yeah, I made a lower high and a lower low. So all this talk is made on, well, he's saying you got a climax, you got less volume here, and you made a lower high and a lower low. So here is your lower low, and here's your lower high, and that's it. Okay, so the market's inability to overcome the high and its failure even to equal the level now clearly defined affording final confirmation of the comparative safety of our short positions. Likewise, a clear warning of the advisability of liquidation by investors who may not have sold up to now, since we have all the elements to corroborate a very big decline. So what are some of the elements? Alright, weak rally, small volume, 6 session, average hesitating, doesn't make a higher high, instead makes a lower high, and that's about it. Basically, demand is done. That's all he's saying. On March 26th, the average starts downward plunging during the recent line of 158, 160, supports on steadily expanding volume over the next 2 sessions. All right. So volume surge. I'll go into all this. So I'm going to stop right here. On March 26th, the average starts downward plunging towards the recent line of 160, 160. Supports on the steady expanding volume over the next 2 sessions. Next 2 sessions, bang, bang. Those 2 volumes, very bearish. Why? Because they're increasing on volume and they're coming from lack of demand. So the important thing to note is these 2 volumes are telling you that the support's not going to hold. Even though it hasn't come to support yet, the pressure coming from that volume is telling you that support is not going to hold. Alright? From here, and it's important because you need to know whether that support is, do you have anything there? And how do you know what's one indication? Well, when you have those 2 bars with heavy volume, it's an indication that the support is not going to hold. The volume surge on March 28th. So we're talking about the volume surge on March 28th. I don't know what the hell. I can barely read this. This print over here is all smudged. But anyway, the volume, if we consider this volume's double, should not be mistaken for a sudden climax. The distinguishing feature between this day's relatively large volume increase and previous volume surges is the latter appeared after an extended or well-developed downward swing, whereas a comparatively high volume of March 28th accompanied the penetration of the March 4th to 27th trading range. All he's saying is a breakdown. It's a trading range is going to get broken, and therefore indicates a large increase in supply stimulated by breaking down the line of support. Okay, so it's breakdown volume, breakout volume. To clarify this, okay, folks, if you don't understand shit, understand this. A sudden or abnormal increase in volume appearing after a given price movement has been in progress, meaning higher bar, and then bang, volume, or low, and then bang, big volume. That sudden increase usually indicates the end of the particular movement. What's he saying? That movement is the swing. So if you have green bar, and then bang, high volume green bar, chances are that high volume green bar is telling you that that swing is going to terminate, because it's at the end of a number of green bars, or at the end of a swing. Or if you have red bar, going down, towards the end of that swing, volume increases. It's telling you that that move is about to end. Alright, so there is 2 things. One is continuation action, and one is ending action. Ending action is high volume at the end of a move. That move could be a swing, it could also be a trend. However, if unusual volume appears when the price is breaking out of a trading range or zone of congestion, then that abnormal volume is continuation. So you have ending action and you have continuation action, or basically breakouts. Okay, continuation of the price movement in the direction of the breakthrough. Thus, if price works up to the top of the trading range and breaks out on large volume, the inference is that somebody is willing to absorb all the overhanging supply around the tops and expecting to push the price to a higher level, and vice versa. In the case of a breakout on the downside of the trading area, when he or they will succeed in extending the movement and accomplishing the purpose intended will depend on existing conditions of the market. So that, okay, all he's saying is when you get to the support and resistance and you have big volume that cracks the trading range, it marks continuation. Continuation. Whereas if you're not breaking a trading range and that volume comes in at the top of a swing or a bottom of a swing, it marks ending action. Therefore, you have to look at a number of other factors. And he's right, because there's a lot of other factors. What is the context? What is the trend? What is this? Is it a stop run? Is it a shakeout? Is it, all that? Is it a false move? Is it an upthrust? Is it spring? Is it high volume upthrust? High volume spring? Does it have follow through? Does it not have follow through? Does it hesitate? Therefore, you do not attempt to apply any of the principles in a mechanical way or as a hard and fast rule, but consider it only in conjunction with other technical manifestations. What he's saying here is, if you think, this is basically saying, what I'm teaching you, if you try to create an indicator or a mechanical indicator, it's not going to work. Why? Because mechanical indicators cannot process all the background information and all the various forms that background information has taken. They're not going to tell you there's preliminary distribution, 1 month ago. It's not going to tell you there's absorption 2 months ago at that particular level. It's not going to tell you that there's a climax and a change of behavior, and before that there was a hyperbolic maneuver and the entire volume increased a lot relative to the entire trend in the background. It's not going to tell you all that. So that's the problem. All of those things you have to apply your judgment for. Mechanical indications follow rules, and they don't. And the thing is, when you look at markets, it's not a hard and fast rule like a crossover. You have to figure out, is this absorption? And that requires the skill of judgment, because it's like there's no 100% that it's absorption. There's some indications, and you kind of have to weigh the bullish and bearish factors to see, yes, this is absorption, not distribution. So you're weighing it, and then even when you weigh it, you're like 70% sure or 80% sure, or sometimes you're unsure. So you're not sure whether there's a distribution, but you're saying, it's more look like accumulation or more look like absorption than it does distribution. So the indicator will try to give you hard and fast red, green, but the mind will not. What the mind will do is tell you, this is 50, or in my case, like it would be like 70% distribution. I'm sorry, absorption. Then you take a look at the past. You say, yeah, that's where it's supposed to be That's where it's supposed to be. One side is getting out and the other side is absorbing. That increases what? The likelihood that it's absorption, and then higher lows, ding, 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 ding. So the mechanical indicator is not going to consider all these factors. Therefore, it'll just give you a green or a red, and typically it's not going to work. So there's too many factors and too many variations of those factors, not only in the current data that you're examining, but in the background. And even that data is like interpretive, 70%, 60%. It's always weighing the bullish and bearish factors. So that's the That's the dilemma with the technical indicators. Alright, so over here, there's a really important, go to section 7M, page 16, and just read this, where it says to clarify this. Just this, and you're going to get a lot out of this section. Tremendous amount out of this section. Alright, I'm done.